what effect is Brexit going to have on the tax system, for the UK?
I think it's helpful to think about taxes, and you're talking about the taxation of a UK-based company.
Yep.
Let's ignore for the moment the cross-border aspects of it, but tax folks tend to put taxes into two broad camps. One is direct tax, one is indirect tax. So direct tax would be things like corporate income tax. Indirect tax would be things like VAT or certain tariffs such as customs. From a direct tax perspective, we don't see a tremendous amount at stake, at least in the near term. I think one of the prior panelists made reference to the fact that the UK's already got a relatively low corporate tax, and if you listen to what's been talked about publicly, it's going to trend even lower. That clearly creates a more favorable environment. If you transition to the indirect side, that's where things arguably could get more interesting quicker. Depending on how individual trade negotiations pan out, you very likely could have a situation where the UK is on the outside looking in. And so transactions between the EU and the UK are no different, absent a trade agreement, than the United States or China or another country. And there you get into a host of issues around the application of VAT, the application of customs duties. But all that is kind of consistent with a little bit of the theme here today. It owes a little bit of wait and see.
Okay. So U.S. multinational companies have used the UK for a variety of tax planning purposes. Can you talk a little bit about how Brexit might change that going forward?
Sure. It is very common for a U.S.-based multinational, even if they don't have robust operations in the U.K., they nonetheless will often use the U.K. as a strategic jurisdiction in cross-border tax planning. So for instance, it's very common for a U.S. multinational to have a U.K. holding company, and that U.K. holding company in turn will own investment throughout the EU or perhaps throughout the world. The attractiveness of that from a strategic standpoint, at least within the EU, is the ability to move cash, whether that be in the form of a dividend or an interest payment or a royalty payment, between those borders without the imposition of a withholding tax. And that's all by virtue of being a member of the EU. If you transition to an environment where the UK is, again, on the outside looking in, then whether or not there's a withholding tax will be a function of whether or not the UK has an individual bilateral income tax treaty with that other jurisdiction. So if a UK holding company owns a German operating subsidiary, for instance, today that dividend can go from Germany to the UK, no withholding tax, and the way the UK system operates, there's no UK corporate income tax on that dividend either. Outside that EU protected zone, there very likely would be a withholding tax, and it very likely would not be creditable in the UK. So that would be a dead cost to moving that cash around. Similarly on using the UK as a finance center or using the UK as a place to own IP and charge royalties or interest streams to the operating companies, that withholding tax could ultimately become a drag that affects the efficacy or the tax efficiency of using the UK in that context.
Is that all stuff that will be on the table in the negotiation? And do you have a view on where that's likely to end up?
I do absolutely will be on the table. The degree to which it becomes a hot button issue, a little bit of it I think depends on the relative strength of the UK treaty network as it currently exists, or it might look years from now. They already have a pretty robust treaty network, so there are not an insignificant, but it's still a handful of countries where this is going to be problematic. So I think you'll see it coming up in negotiations where there are those specific points of pain.
Okay. John talked a lot about the effect of currency on his business, which we've seen across the board in terms of companies either exporting to the UK or having operations there. Does that create any planning opportunities or other tax effects?
Sure. And again, let's talk about it a little bit from the perspective of a UK company and what happens at the UK level, and then we could also talk about it a little bit from a cross-border perspective. For the most part, and there are some exceptions to this, for the most part, currency gains and losses are taxable transactions when they happen within that UK corporation. So to the extent that you're suffering a business currency gain or loss, it's going to affect taxable income. There is an opportunity there, I think, to the extent that some of those transactions are happening in a related party context, for instance. And so the UK might be a creditor or a debtor in an intercompany lending arrangement. You have an opportunity to affirmatively decide which side of the transaction is going to take the currency risk. And you can make that decision in light of effective tax rates as between those two jurisdictions. So I do think there's an opportunity to look at your treasury operations. There's an opportunity to look at where you own and license IP with an eye towards putting that currency gain or loss in the most tax-efficient jurisdiction. If I transition and I look at it from a U.S. multinational's perspective, there are a couple of rather unique opportunities, I think, associated with the devaluation of the pound that people probably could and should take a look at in the here and now. So this kind of falls into the camp of something you might not want to wait any longer to evaluate. To the extent that you are a U.S.-based company and you've decided, and this is not all that uncommon, to treat your UK operation as a tax transparent or a flow-through entity, if you will, treat it as a partnership. And that's an election you can make for U.S. tax purposes. And that's not uncommon. You see it very often from the perspective of a startup operation in the UK, and you want to import those losses into the United States. You might very well structure that in a way to take U.S. tax benefit from those losses. Well, you know, at some point, business becomes successful and now you're paying tax. That same structure actually is disadvantageous, and it can create a tax liability to get out of it. The devaluation of the pound actually has created an opportunity for you to get out of that tax transparent structure and do it in a way that's essentially, or could be essentially, tax-free. There are also opportunities associated with organizations that own not only a UK operating or a holding company, but also a variety of other operating or holding companies in other jurisdictions. And you might want to reorganize internally the way you own those. Typically, that can also create a tax liability for a U.S.-based multinational. And the fact that the pound is devalued versus the U.S. dollar as well as other currencies creates the opportunity to do some of that now under cover of that, you know, that fictitious loss, if you will. And you can do some of that planning in a way that actually affords you an opportunity to get cash out of the UK or other European operations on a very tax-efficient or perhaps even a tax-free basis.
So you talked about you're seeing this issue from both sides of the English Channel. What's interesting to you, or what's the other side of the coin, so to speak, on these issues?
So it is interesting. In preparation for today, I actually reached out to a couple of my partners in our member firm, and their bias is obviously to paint a picture that's as favorable as possible. The UK is open for business, and I personally happen to believe that strongly. At the same time, if you go talk to a tax professional in the Netherlands or Germany or Belgium, some of the other jurisdictions that compete, if you will, for headquarters locations, you can certainly see friendly, sharp elbows, perhaps. Some of these other jurisdictions are being a little opportunistic as it relates to going out and playing up the, you know, there used to be sort of a very objective conversation about the pros and cons. You can line up the tax attributes of doing business in jurisdiction A versus B, and you can You can build data points to make a business decision. Now you've got that added component of, well, the uncertainty, or what's going to happen post-Brexit as it relates to the attractiveness of the UK. And some of these other jurisdictions I do think are designing marketing materials almost, if you will, around some of those opportunities.
So in our own region, we have a border between us and South Carolina and an economic incentive battle that goes on all the time. The UK has been a leader in the EU from a corporate tax reform effort to close tax jurisdiction shopping and tax avoidance. Do you see this changing with Brexit? Does it create an opportunity for the UK to forge a different path and use more in tax incentives to shop for business, or how do you see that playing out?
I do. At the same time, it's an admittedly fine line that they need to walk. If you look at the global conversation around international tax reform, the acronym that you'll probably bump into the most is BEPS. And that's an OECD-led initiative. BEPS is an acronym for base erosion and profit shifting. And it really is designed at the highest level to suggest a body of rules to jurisdictions throughout the OECD as a guideline. You adopt this type of rule, and it will help us combat, if you will, at least the perception that large multinational companies are able to take advantage or arbitrage the respective rules between jurisdictions. And at the same time, as your question suggests, is there unhealthy tax competition going on? Same way between North Carolina and South Carolina, Georgia. The UK has been a very strong proponent of BEPS. And they've got some internal rules that are actually out in front of BEPS. The diverted profits tax would be a very good example of that. And I continue to think there's very strong political support in the UK for all things BEPS. At the same time, you see this lowering and lowering and lowering of the baseline corporate rate. So I do think there's an opportunity for the UK to become a more attractive jurisdiction from a tax planning perspective. But I think it needs to be done with a little bit of an eye on caution about the optics of what that might look like. At the same time, there are EU-driven perspectives that go well beyond BEPS. ATAD is another acronym you might hear. It's a set of rules that takes the outline of BEPS and actually adds more rigor to it. And it's in a way that a lot of countries, including the UK, aren't necessarily on board with. And so a UK outside of the EU would allow them the freedom and flexibility to only pick up the pieces of that global tax reform that they think is a right fit for the UK.